Right. This would be part four. Now let's carry on. So here we're talking about revaluation of non-current assets. And um, let's just follow it. Typically, like we said, typically most assets, I don't think that's new for you, are always, as you would imagine, introduced at cost. And you have a choice. This is accounting policy. You go with a cost model and leave it at cost and then revalue as you're going. Typically, if you had a factory and nothing much was happening, if you had an office block, maybe say, I don't know, in town and house prices are constantly changing, you might wish to go for the revaluation model. That's you have those options. So property, plant, and equipment may be carried at a revalued amount less any subsequent accumulated depreciation. So you must still depreciate. I'll repeat that. You must still depreciate. Um, and if the revaluation alternative is used, you must do this regularly. I mean, we want these things to be true and fair. We want them to be regular. And the other thing is that there is no cherry picking. So if you have a range of non-current assets, you have to revalue all of them. You cannot just revalue the one building. You have to revalue all the buildings, if you like, that you have. So all the machines, if that's what you're revaluing. That's the other point. So yeah, so I mean, I'll do some double entry with how we deal with this when we see examples, but ultimately, we revalue the asset's cost to the new valuation. We eliminate any existing accumulated depreciation for the asset. We show the total increase in other comprehensive income, like I say, because this is not these gains are not recognized um, in the statement of profit or loss as continuing or as trading income. They're recognized in a separate statement of other comprehensive income. And then these would be taken to revaluation surplus and then later on recycled into retained earnings. So these are the journals, but I'll do it and you'll see. I'll do an example in a second, so you can see how it's going. But again, like I say, recognized within other comprehensive income. Again, this revaluation surplus, it's important to remember that is a capital reserve and not distributable to shareholders. So that's if you remember your statement of, you have revenue reserves, and you have capital reserves. So typically share premium and revaluation reserves are capital reserves. And if you like, and you can only really distribute dividends, so profits, and if you like, retained earnings, things like that, are where you would have your revenue reserve, and that's where you distribute your dividends from. And revaluation loss, if you like, is an impairment in the asset. So losses go straight through to the income statement. And what we can do when a revaluation loss arises on a previously revalued, it should be deducted first against the previous revaluation gain, and then can then be taken into the other comprehensive income for the year. So any excess impairment will be recorded as an impairment, and note that the offset of gains is not permitted. So you can't sort of offset different properties. No, you can't do that. Let's do this example. Let's just see what's going on here. And again, I'll just do it via double entry as we would in practice and see what's going on. Entity revalues its buildings and decides to incorporate the revaluation into its financial statements. Here we are. This is the situation. We have an asset that has a building with cost of 1.2 million and so far depreciation of 144. So let's just do that here. Cost 1200 and accumulated depreciation 144. So that's what we have. Again, this is at the 31st of December. This at the 31st of December 2007. So you open your opening balance 1st of Jan 2008. 1st of Jan. Oops, sorry, it's my pen. Oops, here we are. 1st of Jan 08. 1st of Jan 08. You now have, I'll just change my pen color. You now revalue the asset. It says that you revalue the asset to 1.4 million. So it's now 1.4 million. So the first thing we do, this is important, is here we are. Here's my statement of other comprehensive income. I'm just going to call it really just this other comprehensive income. It's other comprehensive income is to transfer these gains into that statement. We can't see these gains sitting in our normal statement of profit or loss. So the first thing I do, you see, because ultimately I want this is a brand new asset now at the beginning of the year that's worth 1.4 million with no accumulated depreciation, right? Because it's just brand new. So I need to first of all, of course, if you like, debit the accumulated depreciation account and credit, if you like, accumulated depreciation and credit this with 144. So now this is now 0. And then, of course, now add on an extra 200 here and add on another 200 here. So in effect, my carry down figure technically at this point is 344, and that's the situation at the beginning of the year. So that's all sitting there. But this is at the beginning of the year. So if you look at the question then goes on to say, it wants to know what's going on at the end of the year, and it tells you that its useful life is 40 years. So I now need to depreciate this new asset, that's 1.4 million, over 40 years. I'll bring up my calculator. 1400 divided by 40 is 35. So technically, I can sort of do this and then have here 35, if you like, and that's my depreciation expense, 35. Yeah. And that's it. I'll talk later on about what we could do to reduce this depreciation figure, bringing it to gradually taking a bit from here and bringing it here based on what it was previously. If you wish to do that, you have that option. But for now, that's the process, how we deal with that. There's some other questions actually. Sorry, forgive me. Let me just come to the so, and this is how they lay it out in the kind of, this is really how you would see it, I guess, as a disclosure, if you like. So there you are, the depreciation, gain on revaluation, land and buildings, of course, which is of course me netting off the 1,400 and the 35, right? Because that's the accumulated depreciation is 1,400 minus 35. Sorry, accumulated 35. The net book value is 1,400 minus 35, which would be 1,365. Okay, great. And that's pretty much how you would see that. That's the layout, really. That's the revaluation gain which we calculated. I just showed you the double entry so you can actually see what's going on. Okay, there's some more notes before we see. I believe that's what's here. So here we are. Once an asset has been revalued, the following treatment is required. We've done it. Depreciation must be charged based on valuation less residual over the remaining useful life of the asset. That was the 40 years. In that case, there was no residual value. The whole charge must go to the profit or statement of profit or loss. We did. We put the whole of that 35 to the statement of profit or loss. And like I was saying earlier, an annual reserve transfer may be made from reval to retained earnings for the additional depreciation charged to the revalued amount compared to the cost. And it's really about the imbalance, if you like, due to the increased depreciation charge. And this transfer would be shown in the statement of changes in equity. But we're just moving that figure, if you like, really just to balance the depreciation charge. It's too high. In actual sense, it does make sense because you can't be, it seems slightly disjointed that you have a whole whack going through the income statement, which includes revaluation, but you don't have any, you're not recognizing that revaluation, so to speak, through the income statement, any of that profit. So it does make sense to kind of balance it out. Yes, so there we are. Let's see an example. I think it's best just doing a journal thing, and hopefully we'll see one. Okay, great stuff. So here we are. This is an interesting one, but I think it's just a good question to just play with. Let me see if I give myself some working space. Let me just come out and give myself a working page to work with. Oh, it just goes so quickly. I don't know when it was. It was literally 3 minutes ago. Now it's not 9 minutes, and I'm hoping to do these in every 10. Let's talk about this, what's going on here. So on the 1st of April, fair value of this zoo property was 100,000. Then let's just write that there. Fair value, the property was 100,000. With a remaining life of 20 years. Okay, so their policy is to revalue their property at each year end, so they've done that. And I just want to kind of come here, and the balance, they had a revaluation surplus on the same date at the 1st of April of 20,000. So here there is a revaluation reserve of 20,000 sitting there. Okay, then it says here that Zoo's policy is to revalue its property at each year end. At the 31st of March, the property was valued at 86,000, and the remaining life, if you see here, is 20 years. So it means that this is the beginning of my year, which was the 1st of April, X8. So I will carry out my depreciation as normal. It's over 20 years. So if this is over 20 years, then that's really there's no residual value. So 100 over 20 is equal to 5 thou. So I have 5,000 as my depreciation charge, and I have accumulated depreciation of 5,000 as well. So technically, this is technically the net book value is really 95,000. Let's change my pen color. And then it tells me that you now have a situation where we have revalued, the property is revalued to 86,000. So the double entry manner of this, so let's do it that way, is that this is now, the value of this thing now is now 86,000. That's what we must recognize. Basically, the carried down value must be, if you like, 86. That's my job at the end of the day. I need to get that down to 86. So what do? Well, that means I'm going to have to drop this, if you like, by 14,000. And if you like, here's my, if you like, loss on revaluation of 14,000, right? But what I can do as well, what I will do as well, if you like, is I will as well, you can see this accumulated depreciation has to disappear. It has to go, because I cannot remember, this is becoming the new value of this thing now is 86. So this has to be 0, the accumulated depreciation. So I need to now technically also debit accumulated depreciation, and if you like, transfer that into the loss. So really the net loss, which is really what it was, is really 9,000. I mean, we know it mentally because we're saying, well, Oyen, if this thing is 95,000 and it's fallen to 86,000, it's fallen by 9, hasn't it? But how do we show that via double entry? And this is how we show that fall, if you like, in depreciation. 1 second. Let me just. My mouse is playing up. Right. So you have that first. Now remember, you also have a revaluation reserve, if you like, of 20,000. So what you can do as well, the standard allows you, is to. I mean, you're basically suffering a loss of 9 here, right, in your loss of revaluation. So what you can do is you can transfer from this reserve 9, to offset that overall loss of 9 from the revaluation. You can literally transfer 9, from here into your income statement to offset that loss altogether. So your new carry down figure becomes 11,000. Your new revaluation reserve becomes 11,000. So what am I saying? The first thing you have to do is you need to deal with the asset as it is. You have to depreciate the asset, of course, first of all. This is not an investment asset. It's only investment assets that we don't depreciate. A normal asset in normal day-to-day, we must depreciate and show this, because you see, we must show this 5,000 against revenue, because that's the accrual concept. So this 5,000 lives because it has generated a revenue of whatever it's done. It's done. That's the accruals concept. Now let's look at the asset itself. It's gone from 95,000 net book to 86,000 net book, which is technically a fall in 9. How do I deal with the double entry of that? I'm recognizing 5 in accumulated depreciation. Take 5 out of here to the loss of revaluation, and of course depreciate this, bring this down by 14 to bring that, and then you have a net of 9. But then you have revaluation reserve, if you like, from the previous period, and so you can also you can transfer 9 from here to offset that loss, if you like, in the year, leaving you a revaluation reserve of 11. Let me just go on to the next one, because I'm far gone the normal time. Oh, hasn't kept it. Has it kept it? Oh, I lost all of that. That's fine. At least it's recorded. Then the next question, I think, that then says to us, show what would have happened if the revaluation surplus did not exist. So really, what we would have simply had was a scenario where you had 100, and then you had 100,000. This is what you had. Asset. Accumulated depreciation would have been 5. Accumulated depreciation would have been 5. Now we know the net book is 95. You're bringing it down. Change my pen color to 86. So if you're bringing it down to 86, you drop 14 here. If you like, loss on reval, 14, and you transfer the 5 out of here into here. So you have an overall loss through your income statement of 9, and that's it. You don't have any, there's no revaluation reserve, right? This question tells us there is nothing. So that's a moot point. There's nothing there. So this is how it would look, if you like, overall. Okay, great. That's long. So we'll move on to TYU2. I think I'll do TYU2 as well as another example to support this, and then we'll carry on.